So just to orient you, this is the third session that we've done on the topic of value creation. First one was alignment. So I consider alignment to be the first value creation lever. Number two was operational efficiency and improvement. We're here today talking about financial data reporting and analytics. In Joyce, in 2 weeks, a month, something like that, we'll be talking about organic growth and go-to-market strategy. The fifth one is add-on acquisitions and integration. And then we'll wrap things up on this context with preparing to exit. So here's the topic for today, financial data reporting and analytics. These are the 7 sub-levers. So think of these as the arrows in the quiver that you have as you go about creating value through financial data reporting analytics. And we're going to go through these one at a time, but just to orient you, when we go through each of these sub-levers one at a time over the course of the next 55 minutes or whatever, we're going to go through 4 stages, so 4 steps. The first step is during diligence. The second one is during the first 100 days. Third, throughout the rest of the hold period. And then finally, preparing to exit. So the material is, as you can imagine, somewhat, there's a lot of overlap. And there would have been a much more efficient way to do this, but this is the way, this is the way I started with all of these value creation levers. So we've got that. So that's one hurdle that we all as a group need to overcome, is that there will be some duplication. The second hurdle that I'm asking for in terms of your help and patience is in the chat. If you're willing to share comments, feedback, not only questions, but also like, hey kid, here's another way to think about it, or you missed something, right? That's going to be very helpful for me. So I'm going to try to remember to save the chat. Joyce, do you routinely? Yeah, okay, cool. So I'm going to try to get that. So you guys, I am the least, what's the right way to put it? The least experienced financial operator on this call. I'm almost undoubtedly. So this is a little bit awkward for me, but so I'm asking for your patience and your help and your forgiveness in advance. So let's dive in. Sublever number 1 is the financial review and an assessment of risk. So we want to build the bedrock. Investors walk into a portfolio company expecting to accelerate growth. That's what they want to do. That's the fun part. But what we first have to do is make sure we understand the numbers and that they're clear. So during diligence, financial diligence, obviously we're looking at things like liquidity, working cap, cash flow cycles, debt, and so on. But we also want to understand how much integrity is in the numbers. Are there gaps? Are there inconsistencies? Are there errors? Are they relying on non-GAAP metrics? We want to understand risk. So all sorts of risk so that we can take steps to eliminate that risk and then make sound investments going forward. Obviously, working capital reviews, CapEx, understanding audit, preparing for potential audits, and then thinking about the team, the talent. So how much acumen, how much strength, experience, wisdom do we have with the team? Are they reactive? Are they planning? And so forth. So that's stage 1. Stage 2 is during the first 100 days, we want to start training the team, explaining what the reporting package should look like, begin the process of forecasting, trying to find ways to unlock and unleash cash, strengthen controls, and then bringing about improvements. So for example, enhancing the budgeting process or moving from spreadsheets or QuickBooks to something else. Then during the hold period, we want to maintain rigor, monitor risk. So transparency becomes important. Transparency for everybody so that the entire management team has visibility to actual numbers and can make better decisions, more informed decisions as a result of understanding the implications of the numbers. So being able to track and report on KPIs that are tied to the strategy and auditing. So there's two parts to auditing: internal audits and then preparing for audits, being ready for external audits. And then scenario planning. We're going to get into one of the sub levers is scenario planning. So we're going to get into that more. And then regulatory change or any external change for that matter. Just maintaining awareness of potential risks there. The fourth step, the last step in sublever one, is preparing for exit. So we want to be able to tell a story that buyers can trust. So we want to have board level reporting packs that are ready and consistent and audit ready. We want to demonstrate evidence of discipline and decision making, the ability to present documentation, but also obviously strong numbers. Now, keep in mind, we're going to go through these four: diligence, first 100 days, the whole period throughout, preparing to exit. We're going to go through all that stuff 6 more times. And each time is going to be a little bit different because we're talking about different sublevers. So I'm going to pause here and just see if anybody has any questions or reactions thus far. I don't hear anything. I don't see anything. So we'll just keep going.
Yeah, Kit, I might add a few more areas of risk assessment. You know, could be brand, could be vendor. You pointed out regulatory, et cetera. So I,
Yep.
it's
Vendor risk.
it's an area that keeps getting bigger every day.
Thanks, Bill. I appreciate it. So financial data integrity. So I don't know if anybody remembers Captain Chaos, but regardless of that, the lifeblood of decision makings is accurate data. So the problem is that a lot of lower middle market businesses, whether they're private equity backed or founder led, are dealing with, fragmented systems, that weak data, weak accountability, and so forth. So we want to understand the quality of the data. Is it verifiable? Is it trustable? And then is there a central source of truth, or do you have to sort through a whole bunch of different tools or systems to find what you need? So during diligence, we want to go back in time, trace entries and adjustments, or make sure that there is a policy, a procedure, a protocol. What is the standard operating procedure, or are we just trusting some individual's memory? Are we standard compliant? And then gap analysis, 1A, not 2As. What are we missing? Control, policy, infrastructure gaps. And then the cadence of reporting. Is it, how frequently, and is it consistent? Then when we get into the first 100 days, we want to be able to report in a scalable way. So we have to train the finance team. We have to upgrade the systems. We need to have internal controls, documented approvals, account owners, thresholds for journal entries. And then we need to standardize the reporting. What does it look like? What are the metrics? What are the KPIs? And of course, that's somewhat board dependent. They'll dictate exactly what they want to see. And then we need to be able to customize the reporting for users. So the stakeholders are making effective decisions based on reality. So it's tied to the strategy, but it's also cross-functional. So everybody can make better, more effective decisions that are cross-pollinated essentially. And then there should be a standard, consistent monthly close process. During the hold period, we want to sustain integrity. So this theme of transparency is going to show up again and again and again, like providing everybody with clear, fact-based, objective insights to enable them to make objective decisions. Discipline, meaning on time, robust. And I'm going to say this probably several times during the course of this hour, but in a private equity world, for those of you who are not private equity backed, a lot of the reporting is numbers, and that's good enough. But in private equity, it's not good enough. You really need to understand the why and be prepared for the collaborative conversation. So the analysis is really important. The why and since when and what if is important in private equity contexts. Once you have policies, then they need to be enforced. People need to be held accountable. We keep talking about audit ready. Um, we keep talking about being aligned with strategy or aligned with the value creation plan, the investment thesis, and then cross-system consistency. So that cross-pollination that I was referring to earlier. And then lastly, top left, system performance tracking. In other words, we want to know how good a job we are doing in terms of forecasting, for example, right? So tracking the performance of the system. Then as we prepare to exit, we want to be able to market the business in a way that shows how mature it is, how well the business has invested, and how what a good job the business has done in reducing risk. So mature reporting in private equity earns confidence and accelerates diligence because there's less ambiguity to worry about. So that involves access, so providing access to the ERP, to the dashboards, making it transparent, visible, um, demonstrating the transformation that's already occurred. This is where we started. This is what we changed. This is what we upgraded. And then all of that is designed to inspire confidence. So people look at, okay, you have a well-functioning finance team that is enabling more effective and more efficient strategic decisions to be made. Again, I will turn back to you and pause and see if anybody has any questions. All right, well, then we'll keep going. Um, Remember, if you hear something that's alarming, surprising, maybe not complete, or you disagree with something, just put it in the chat for me. I'd appreciate it. Profitability and capital efficiency. So obviously two different things. Growth is what's most exciting to most private equity investors. They're here for improvements to, revenue, for example. But at the end of the day, on the right-hand side, you see private equity firms win by improving how the dollars flow through the business, not just chasing new revenue. So we want to become more efficient as well as growing the business. And in order to understand that, we have to figure out where we're wasting capital, where are there opportunities for improvement, where are margins being masked. I'm going to start in the top right, sort of at the 1 o'clock position here, margin bridge analysis. And then we go to a working capital review, KPI audit. Like, are we looking at the right metrics? Are they just vanity metrics? Are we being consistent about it? How are we improving over time? Cost drivers, the maturity of our BI system. Is anything missing there? Do we need to upgrade? CapEx. We want to look for underperforming investments, sunk costs, areas that just are not panning out that might be legacy sacred cows, but maybe they just don't make any rational sense anymore. And then the capital intensity benchmark. So in other words, the business's capital requirements versus the norm of other companies in the same industry or segment. Then in the first 100 days, in other words, after diligence is complete, we're going to be installing tools, training teams, making decisions. So forward-looking KPIs. And then we want to be able to not only improve what the KPIs say, but be able to tell stories around those metrics. So this is a skill that has to be taught. It's, muscles that maybe haven't been there before, and being able to demonstrate the narrative or share the narrative may take some time and you know, it's like riding a bicycle, I guess. Um, the dashboard, then we get into governance, cost optimization, a margin bridge, ROIC improvement plan, and then we get into aligning the plan with the management team. In other words,
Kid, somebody's asking to explain what ROIC is.
oh, it's return on invested capital. So in private equity, it's the most important metric for a private equity group, and it's really, frankly, how everybody's compensated. Bill McNitt, anything to add there? I'm not sure if Bill's
Nothing.
okay. Um, so ROIC is irrelevant for those of you who are not in private equity. Sorry about that. So then during the hold period, which might in private equity parlance, we used to think of it about 3 years, 4 years, and now it's 5, 6, 7 years. So however long that hold period is, for this particular sublever, we're focused on managing the margins, so tracking KPIs, making sure the dashboard is dynamic. In other words, we'll change it as needed. It's not just static. We do need to benchmark to understand how we're performing, provide active, not passive inputs, make some changes, again, reassess our KPIs. We'll do some scenario planning and then provide feedback. When I say input, it really ultimately is feedback loops. And then lastly, for this sublever, preparing for exit, I keep using the term marketing because essentially what you're doing is you're preparing to demonstrate that this business deserves a high multiple, a high value. And in order to do that for this particular lever, financial data, analytics, and reporting, what we have to do is demonstrate that we've got a system in place, a scalable system. So as the business gets larger, as we do add-on acquisitions, for example, this team has a known way of doing things and has a system in place and a process so that at the end of the day, we're enabling the decision makers, the strategic decision makers, to make more effective and more efficient decisions. That's really what this is about. So we want to provide confidence that that's in place. So over on the left, an experienced, knowledgeable team, the ability to improve ROIC. So from one investment to the next, or from one add-on to the next. Again, that's return on invested capital. Um, and then the story of margin expansion, not just the numbers, but what's the story? What are the decisions that have been made, the pivots that have been made, the lessons learned, so that we don't make the same mistakes in the future. Clean, clear, obvious dashboards, and then financial discipline. I like the verbiage there in italics down at the bottom. Profitability and capital efficiency are obviously different, but they're mutually reinforcing flywheels. You can't scale what is not profitable, at least in private equity. I suppose in a venture business you can, in a public company you can, but in private equity you shouldn't. So you have to be efficient with capital. All right, we're moving right along. Now we're going to talk about my favorite of these sublevers, which is board and investor reporting. Before we dive in, I'll just pause. And I'm waiting for comments or questions. I don't see any, hear any. Okay.
Kit, can I
Keep,
ask a quick question?
please do.
What's the expected minimum IRR for private equity to consider investment? Any benchmarks around there or any general trends?
Yeah, so again, multiple on invested capital or return on invested capital is typically the term rather than IRR, but a 2.0 is sort of an expected level. If you get up to, say, a 4.0 or higher, then you're really crushing it and doing a fantastic job. So in our community called the operators.pe, we actually ask the private equity backed executives who are members to tell us what the ROIC was of their most recent portfolio company. And the ones that have reported a 4.0 or higher are, that's impressive. Did that help you, Omar? You're muted now.
4.0 is 4 times the returns, right? That's what 4.0 is, right? I'm assuming.
Yeah.
And Kit, what's the generally, have you seen the portfolio companies not meeting the expected return requirement, generally 10%, 15%? What's the private investing company has in mind before it's investing in those portfolio companies? And how many of them will return the required return requirements?
Yeah, I'm gonna answer and then I'm gonna turn to Chris Rooks and anybody else that wants to weigh in. So those of you who have experience in a private equity backed environment, feel free to weigh in. But I would say that one of the many differences between venture capital and private equity is that the expectation is not that one company in the portfolio is going to hit a grand slam and two or three are going to maybe hit a triple and the rest are going to go bankrupt. That's not the way it works in private equity. Every business needs to, if there's one company in the portfolio that goes bankrupt or that failed to perform, then it's really, really bad. It's not good. So I'd say what happens is you extend the timeline. So
Okay.
instead of selling in 4 years, maybe you sell in 8 years because you're just continuing to work hard, maybe hire a new CEO, do whatever you need to do to get it to the point where you can sell it and present the limited partners, in other words, the investors, present them with that score that's high enough to warrant their reinvesting, because that's really what it's all about. Chris or anybody else?
Yeah, I would just add I don't have the stats offhand, but PitchBook has lots of data on returns, on kind of percentile returns or quartile returns based on vintage and the type of fund. And I would just say that, yeah, like Kit said, it's not like in VC where you might lose, you know, you could lose all of your money. Basically, you could, some of the worst performing funds generally at least get back your money with a small return. But those types of funds will have trouble raising a second fund. And the other thing I would say on the MOIC is, Kit mentioned 4.0. I think it depends on the sector too. So more,
Yeah.
fast growing sectors might come, the target might be 4.0, but it might be, say, 3.0 if it's kind of a stable, steady Eddie business, that there isn't much variability or volatility. And so I think the sector matters as well. So those are just
Yeah,
my comments.
that's good. Thanks, Chris. Anybody else?
Thank you.
All right. Well, then we'll keep charging. So what we have here, I kind of created this little image. We've got this guy pulling the lever, but it's the lever of board reporting. So, this is sort of my way of encouraging you to remember board reporting isn't just about handing over numbers or asking for um, approval of a budget. At least in private equity, it's about a collaborative conversation. So, you want to create momentum and not only inspire confidence, but gain better insight and better clarity from a wise, experienced board. And same thing here, this blue arrow is really pointing to the board presentation, but it's really based on you get to that point of communicating the numbers and communicating the story by having good quality reporting. One of the expressions that I like to share is the board meeting happens before the board meeting. And really what that's intended to say is that you're socializing the data ahead of time so that in the board meeting, it's not like a surprise. The board meeting is really an intellectually stimulating conversation. So we have reporting, we have KPIs, we want to analyze the KPIs, what's relevant, what's interesting, what's new. We want to be able to provide forecasts that are, um, based on the right data. And then we want to be able to ensure that they're effective and the forecasts are rigorous. But that all leads to the opportunity to have a good conversation. That's not just numbers. So the second step, so again, what we're talking about here is board and investor reporting. So during the first 100 days, immediately after the acquisition, this is the most critical period. We really want to ensure alignment with the board. And in order to ensure alignment, we've got to be talking the same language, sharing the same information. So we want to have a package that's what they want, what they expect to receive. It ideally is real time, which is enabled by systems. And then we want to have the ability of the management team to be able to tell a clear, consistent narrative. And that often involves training for them because they've never done that before. And then that narrative needs to be customized or tailored to different audiences. So the lenders, the board, lower level managers in the company. And then we want to have a governance, uh, essentially a calendar of governance. During the hold period, which again could be anywhere from the next 3 to 7+ years, reporting becomes a confidence flywheel. In some cases, private equity boards are extremely hands-on. And in other cases, private equity boards can be uncomfortably hands-off. But at the end of the day, sometimes their level of confidence is inspired by the data that they receive from you. So we want to be transparent. That's the first step. We want to provide feedback that's useful and effective, keeps them engaged, and obviously consistent messaging. And we want to incorporate scenario planning. So that's just one example. What happens if revenue dips or if interest rates spike? Um, there is a whole section here on scenario planning, so we'll get into that.
I think in some sense, maybe you're being very nice to private equity because there are cases where the private equity firm will be calling up the operators and the chief financial officer maybe every day in that first 100. So, I mean, you're right. There's a variety, but
Yeah. I'm so glad that you jumped in and said that, Bill, sincerely, because you're right. And so when I said, people often say you never get exactly the right amount of input from the board. It's either too little or too much. That's an accurate statement. Some board members are calling the shots, and some board members are on the phone every single day with somebody.
but you have to also in private equity, uh, the majority of the boards are inside people. I mean, I'm not saying there aren't, independent directors, but it's the private equity investors.
The outside of the outside board members are in fact rare.
Yeah.
And what I'll add one more comment to this before we move on. So I run peer advisory groups. Strategic Growth Council is one, and Value Creation Council is the other. And in our peer advisory groups, it's essentially a mastermind or roundtable in which we're not socializing, we're not networking, it's not a lead share group. It's very specifically solving up at night dilemmas. And the reason that I brought that up is one of our members specifically said, and this is fairly recent, they said, I have a board member literally telling me what to do, like day in, day out, putting stuff in my calendar, telling me what to say to people on my own team. And so they were expressing like, this is crazy. Like, is it a lack of confidence in me? What kind of conversation should I be having with this person or the rest of the board? Or, this is nuts. And one of our peers in the group said, well, hang on a second. Well, just back up a little bit. These board members are former CEOs, most likely, or CFOs. They've been there, done that. They've spent an entire career. They have the best interests at heart. They're just trying to help. So before you get, everything tied up in an ugly knot, just realize that's just the way they think. They're hands-on type A people. And that's not the way I would have answered that dilemma, but it helped. Okay, so we're now getting into preparing for exit. So in terms of the board reporting, it does become a part of the valuation story, meaning that we're demonstrating to a potential buyer that we have scalable systems, that we have an amazing team, that we've been able to produce not only good numbers, but trustworthy numbers. We've been able to document the decisions that we've made, the way we've done things. In other words, we're presenting a story that should inspire confidence and reduce the level of presumed risk that the buyers might have about, hey, do we have the right team, the right systems, the right processes in place to scale? Sublever 5 is budgeting and forecasting. So most annual budgets in most companies aren't very long-lived. Maybe they exist in silos. Maybe they're based on spurious data. You want to just sort of get the budget approved and get it done and then move on to other stuff. But in most private equity backed portfolio companies, that's not good enough. The budget really needs to inform decision making, and it ties in obviously with forecasting. So the purpose of diligence is to look for red flags, look for problems. Do we want to do this deal or not? What are the risk factors that we need to be aware of? So is the budgeting process structured, repeatable? Can we trust it? Same thing with the cash flow forecasts. Are they real? Strategic analysis is there a connection between strategy and numbers, financial assumptions, financial forecasts? Obviously, everything needs to be accurate. And then are they taking into account, in this company, are they taking into account a wide variety of potential problems or scenarios? So then in the first 100 days, there has to be a bridge that connects financial decision-making, financial analytics to strategy, or more specifically in private equity, to the investment thesis and the value creation plan. Bottom-up ownership basically means lower level managers are making decisions that are informed and instructed, I guess, by accurate and transparent data that's real and trustworthy. So bottom-up ownership. Scenario modeling, upside, downside, and base case. So we're not just presenting one scenario, but multiple scenarios. And then dynamic forecasts, rolling forecasts, updated forecasts, the ability to integrate KPIs into the budgets and forecasts, and then systems or tools that allow us to predict, essentially. Then, during the hold period, again, the next up to perhaps 7 years, the focus shifts from inspection and trying to reduce risks to continuous improvement. So under the heading of continuous improvement, we want to become more accurate. We want to refresh the assumptions or update the assumptions that we've made. We want to, improve our templates and KPIs, and then hold people accountable, maintain discipline in terms of timelines, limits, reporting standards. All right. Prepare for exit. So forecasting is a signal of sophistication and confidence and reduced risk. Um, we want a track record of forecast accuracy. So we want to go back and say, look, we made this forecast and here was the result. And that's very compelling if you're able to demonstrate accuracy of your forecast. But also to demonstrate discipline, credibility, and then the buyers get excited when they see models, tools, and forecasts that are compelling. And, obviously they're transferable and demonstrate sophistication. So down at the bottom, budgeting, forecasting are operational X-rays. It's sort of like a compass. The sharper the process, the stronger the execution, the more valuable the business. Um, And it probably deserves mentioning since this whole presentation is sort of focused on private equity, since this is the private equity special interest group, that in a lot of businesses, the goal of the business is maybe to maximize profitability or maximize growth, or maybe it's just a legacy business that provides income for a family owner. But in private equity, it's different. In private equity, you have a hold period, and then, everybody is striving towards a liquidity event. In other words, everything is leading towards a sale. And so one of our value creation levers is preparing to exit. And so you might think, well, that doesn't sound like value creation, but it is. It truly is. So just wanted to make that point. We only have two more to go through, and so we're right on time here. So we're on working capital. Working capital isn't very sexy, but what I would describe it as is it's where operational discipline meets financial rigor. If we do it right, it builds resilience, buys you options, and then earns credibility with investors. So during diligence, we're really looking for cash. We're looking for where is cash being wasted. So are the forecasts that are being presented by the sellers real, reasonable, reliable, accurate? What's their cash conversion cycle look like? How efficient is working capital? And then we want to benchmark DSO, DIO, DPO, benchmark the cash conversion cycle. How has the company handled liquidity stress, problems with liquidity? And then have they used free cash flow in unsophisticated, imprudent, foolish, experimental ways? And that either, when you're doing diligence and you're thinking about all this stuff, there's really two ways to think about it. It's either, wow, that's really discouraging. They haven't made very shrewd decisions. Maybe that connotes risk. Or you look at it and say, wow, they generated that much profit when they're this unsophisticated. Woohoo! Wait till we get our hands on this thing. We're going to really improve this business. So again, two ways to look at it. So and then we get into the first 100 days. We want to create dashboards because we want all that visibility, right? We want to inspire a cadence of forecasting, tighten up receivables, rationalize inventory, negotiate better terms, create metric-based plans, and then implement capital allocation framework. So a lot of words, but basically we're just improving the way the business handles cash, right? I love my little picture here. It's my little fun as I'm creating these slides. Cash is king. So during the hold period, embed cash consciousness throughout the management team so everybody understands how important cash can be. Cash culture has to be built into the company's DNA. Sometimes this conversation does create a cultural awakening or what's the right way to put it? Conflict. Depending on the culture of the business, the acquiring company or private equity group versus the way things have been done. track KPIs, reassess KPIs, tie incentive compensation to these metrics, benchmark for the industry, model sensitivity. So we want to understand what would happen in a particular scenario or situation down at the bottom. And then refresh policies with customers and vendors, meaning change, meaning make things better for us if we can. And then clarify who owns, and ensure there's cross-pollination. I've used that term a few times, but we want the owners to, the owners meaning the decision makers across functional areas, to have not only visibility to accurate data, but also the ability to utilize it again to make better decisions. And as we prepare to exit, I'm in the top left here. How much free cash flow have we unlocked? We want to be able to tell a story there about cash conversion cycle. Another picture that I like, demonstrate capital allocation rigor. Where did the cash go? How was it invested? Was it invested wisely or squandered? Then down at the bottom right, support the valuation, meaning attractive, less risky through cash management. And then we want to provide a playbook. So really all this is designed to do is provide the buyer with confidence that we've done the right things, we've managed money well, we've made the right decisions, and therefore all this stuff should relate to a higher valuation. And now we're on the final sublever, which is scenario planning. And the first step here is during diligence, we want to understand, does the company actually do any scenario planning at all? Do they have any scenarios? Have they thought about it? You know, what would happen if? And so we can toss out some scenarios of our own. We want to go back in time and understand, like, what happened during COVID? What did you do? What pivots did you make? What did that translate to from a financial standpoint? Maybe they have customer concentration risk, vendor risk, and then how often do they provide updates to their forecasts? Is it kind of static, or is it routinely updated? During the first 100 days, we want to train the team to get in the habit of thinking outside the box, thinking about what if scenarios, and then tie those scenarios to strategy, so that maybe as we think about what our strategy is going forward, we have the ability to think about multiple scenarios that could impact the strategy. Wargaming. So wargaming occurs not just in the military, but we can use the same concept of scenario planning in business, of course. Systems and tools. Test agility. Can the team reforecast in days, not weeks? In other words, how nimble, agile, flexible can the team be in terms of coming up with scenarios or reacting to developments? Stress test the assumptions, and then enable cross-functionality, meaning the scenario planning should be coordinated across departments. It shouldn't be done in silos, in a vacuum. They should be talking about it. During the hold period, so for the next several years, we are changing our forecasts or updating our forecasts. We're making sure they're essentially live. We want to track leading indicators, whatever they are. Provide stress tests on a regular basis. How long does it take for the finance team to go from, hey, we need data, to enabling a strategic decision maker to make an informed decision? Post-mortems, in other words, what are the lessons learned so that we can pivot, so that we can improve? And then KPI alignment. I think this might be our next to last slide. Thanks for your patience, everybody. So prepare for exit, turning what if scenarios into a valuation upside. What we're talking about is a buyer who sees a company that does really effective scenario planning, does it routinely, has a process for it, has proof that their scenarios have been borne out and that they've made really effective and efficient decisions as a result of planning ahead. That's pretty compelling to a buyer. Again, that shows there's less risk here than we would have assumed. So we want to make sure that the scenario models are in the data room. We want to tell the story of how well we've done, what a great job we've done in making predictions, demonstrate capital discipline as well. And then, if we can say, look, we've created value as a result of the scenario planning work we've carried out. For example, we created margin lift because we did scenario planning around what if scenario of price increases, for example. And that provides buyers with trust. So we want to plan for chaos, but prevent it and act decisively. So final slide, private equity is about trust and confidence, reduced risk, wise investments, sound execution. So, this lever, financial data, analytics, reporting, isn't the first to pull necessarily. I would say the first one should be alignment, and that's why it's value creation lever number one. And I would say this isn't the most important lever. However, I would say every other lever really does depend on this. This is like, I call it oxygen. So you guys are the professional athletes of or at least you private equity backed executives in my minds are the professional athletes of the business world. And a professional athlete performs a lot better when they have access to oxygen. If you're out of breath, in other words, if you're not seeing financial data clearly, you're making poor decisions. You're not performing well. So, in private equity, the fastest path to value is paved with clear numbers, clean books, good analysis, healthy and collaborative conversations that lead to confident, effective, efficient decisions.